You know the drill. You research the token, tick is all around X, community is buzzing, everyone is hyped about it. You buy, after a couple of weeks, it starts to bleed out. In bear, in bull, it just goes down. Sound familiar? To me, sounds very familiar. But in 2026, before doing any investing, I will go through my checklist for every single token. Today, I will share this checklist with you. Hi guys, following Bitcoin from 2013 and altcoins from 2017, I survived a couple of bear markets, and every bear market is different, same but still different. And I have my doubts about coins as everybody else, but also some experience regarding it. So let's see how it looks to invest in crypto in 2026. So let's go into it. I prepared some slides regarding this, and I think that we can follow this and try to see the differences and try to see where we should keep our focus this year, this bear market, because you know the bear markets are those when you can actually make a difference to fill your bags with some cheap tokens. But it's different, as it's not the same like a couple of years ago. So let's see what changed. Why do promising charts bleed out every time you research? Everybody is buzzing, everybody seems so bullish in the bull markets, then you buy something and your token just bleed out and it goes down and down and never stops, and bear markets looks like they will last for forever, which isn't like that. Actually, bear markets are usually 1 year and bull markets are 2-3 years. So bear markets are shorter, but it always seems like it's for forever. Okay, so let's see what changed actually between 2021 and 2026. In 2021, I remember I was chasing tokens and I was searching for roadmaps on some ridiculous websites where somebody will just show a roadmap of something, promising something, and then you will buy a token by the promise or buying the narrative. Of course, there will always be some kind of a community, some cheerleaders that will hype the token and then you buy them. And of course, speculative growth, everybody is hyped, everybody is buying, everything is pushing up, and then it just collapses everything. This year, 2026, it's a little bit different. As I said, I had my doubts and I still have some of my doubts. And I will share in this video why I have those doubts. What changed actually in my head. This year we should verify revenue of tokens, analyze unlocks, cash flow analysis, business fundamentals. These things nobody was talking about this 5 years ago. It was ridiculously simple to you buy a token goes up, you sell a token and you earn. If you don't sell, then you go down and go to zero with some of the tokens. Some tokens are not around anymore, which weren't here 5 years ago. So let's go into it. Let's go into 5-pillar framework for capital protection. That's how I would call this. As you can see, we have 5 crucial pillars: inflation rate, burn versus recycle, buybacks, real revenue, and supply unlocks. Actually, it's very simple just to follow these simple things, and you can make a checklist, and under 10 minutes you can see what tokens are promising and what tokens are not. Question number 1, are you running on a treadmill? The inflation rate and dilution risk. So if a token inflates at 20% per year, the market cap must grow 20% just for the price to stay flat. You aren't growing, you are running in a place. So it's very hard to push up market cap of the token, and it's very easy to print additional tokens. So that's a big difference. We saw many tokens. If you index them in Bitcoin, they will just continuously go down, and in USD it's even worse. They never hit again their all-time highs. Very few of them actually hit their all-time highs. For example, Ethereum last year. But for a long time it was just going down and down. But other tokens, check them out, and you will notice that they are very rarely hit their all-time high from the previous cycle. That's because they have a big inflation rate, and they can maybe reach the market cap. Maybe they even beat the market cap from the last all-time high, but the price is still lower because there are more tokens outside. So we should do the rule of thumb here. So the green flag: if the annual inflation is lower than 5%, it is sustainable. If it is more than 15% annual inflation, it's it's dilutive headwind. So your bags are diluted every single day. Even if you are staking, maybe you get like 5-6%, but with inflation of 15, you are actually losing money. It's the same thing like a fiat. So we are escaped from fiat, and we are doing the same thing. So let's not do the same mistake over and over again. So let's go into the second thing, the vesting cliff, the time bomb. So this is the thing with the VCs. We have many of those tokens. Many tokens that actually have a big market cap are usually funded by VCs from the beginning. They have a huge push at the beginning to develop different things, and they develop things. But that comes with the price that after a year, 2, 3, those tokens that are given away to VCs for fresh money which is injected for development have to come back. So they have to monetize their investments. VCs are unlocking their tokens, and they are dumping on you. So insiders often enter at a fraction of a cent. When their lockup ends, they have a massive incentive to sell into your liquidity. So a cliff unlock of if more than 10% of circulating supply within 6 months is a critical danger zone. If you see that there will be 10% more unlocks during 6 months, run away from that token. Unfortunately, you will notice that some of big names are actually have some huge unlocks this year planned, so pay attention on that. This is actually similar to inflation, but they are just a shocking unlocks which happen in 1 month or 1 week, and they can really push the price down. Question number 3, revenue is the reality check. So this is something that nobody cared about 5 years ago. Nobody cared about if there is a revenue on the chain. So if you just do some transactions and there is no revenue, why would you hold that token if that token can't absorb the value? And this is something that will be more and more important this year and in the following years. I would say that the first years of crypto were actually like experimental, and that's why nobody was thinking about these things. But now when you have thousands and thousands of tokens, this can make a huge difference between them. If some token have a revenue model, then it have secured its future. If it doesn't make money from users, it's just a narrative, and you don't want to go into just narratives. Real revenue, on-chain verifiable fees, non-inflationary rewards, that's important. Lower ratio, better value. So let's continue with question number 4. Does the team bet on themselves, buybacks, and fiscal discipline? So this is something that was kind of unpopular a couple of years ago. People were saying, why do you burn tokens? So that's like burning money. Nobody burns money if you just don't value at the money. But actually it's the another way around. If you are burning your tokens, then you are removing the liquidity, and you are doing the opposite of inflation. So if you have an inflation of 10% and you are burning like 12%, your token is deflationary. So you are doing good for your investors. So those who are holding the tokens, their tokens are getting more and more valuable because there are less and less of them outside. It's like concept is the same like in traditional stock buybacks, using treasury revenue to buy the token signals conviction. The team is not hoarding stablecoins; they are aligning with holders. So that's the most important things, that the team is actually on the same side like you. If they are holding the tokens like you, they are believing in their own tokens, so they are not just going out in the stablecoins. So that's very important thing. And of course, the question number 5. Beware of burn theater. So this is something that is very important. So there are 2 types of buybacks of the tokens. One type of buyback is when the team or the token have some automatic buybacks, and those tokens that are bought back are burned and goes to some dead wallet. Like in this example, it's a good thing because nobody can access that wallet. Nobody has keys for that wallet, which means that that liquidity is just moved outside. It is burned, so that it is not anymore liquid, or it's not staked. It's just taken away. And another thing is that sometimes team is team is buying back the tokens, but they are not burning them. They are just putting them or in DAO or distributing to investors through some other ways. So maybe like rewards for doing some social network stuff, or paying development or similar things. So it's not the same thing. The tokens are bought back, so maybe they're pushing price up, but distributing it to developers or to other participants or investors is doing the opposite way. So you have again the sell pressure on the other side. Now it's important the buybacks are going to the burn wallets, and then you know that liquidity is out. Real burning deletes supply forever. Don't forget that. Okay, so this is kind of a checklist before you dive into buying some tokens. This is a checklist that I will try to implement in every single time I were thinking about buying some token. I will try to go through this checklist. So first thing, inflation. Is annual inflation lower than 5%? If it's not, if it's higher, then I will have to check it out how much higher it is. More than 10-50%, that's too much. I will not buy that token. Unlocks. Are there 0 major cliffs? Is there some unlocks in the next 6 months that is over 10% of current supply? If it is, no, I'm not buying that. Revenue. Is there on-chain verifiable revenue? Is there some business model around it? Is it sustainable? Is it self-sustainable? Does it have value to the people? Why would people hold the tokens if there is no business model? If there is no revenue, I'm skipping this. Buybacks. Is there any active buyback program? If there it is, maybe I will think about this inflation and buyback ratio. If the inflation is higher than 5% and buyback is higher than 5%, then I can check more details and maybe go into that token. And burning, of course, are the tokens sent to the dead wallet, or they are just regurgitated and going back to some DAO or the team. If they are going to the team and not to the dead wallet, I will not go into that token. So scoring 505, investable candidate, 2+ failures, high risk speculation. So if there are 2 or more of these failures, I will have to dive deeper and see what happens with those tokens, and maybe go into them. But if they are all ticked green, all 5, I'm willing to invest in them, because as I said, bear markets are the perfect time to fill your bag with some quality tokens, not any tokens, but quality tokens. And the gap between what the crowd does and what the data says is your profit margin. Ignore the vibes, verify on-chain, trust the framework. So don't trust people, don't trust hype. Just verify and go into the things that you believe that are ticking those boxes that we just go through. So that will be all for this time. I hope that you like this checklist, and I would suggest you to research tokens and follow this checklist, and I bet you will be a better investor. This is not an financial advice, of course. This is something that I will follow in this year, and if you find this valuable, don't forget to follow this channel. Don't forget to upvote the post, upvote this content, and subscribe to the channel. See you in the next video. Bye bye.